Hello and welcome back. I am Robert and we're here to talk more about lazy trading. Now let's take a look at the live chart and get right into it. We see that I've added a few more lines to the chart. Just because we are trading in a lazy way doesn't mean we're doing so without knowledge or education about the market we are trading in. You must study the market and understand it, because that helps you figure out exactly what to look for and how to place your trades. Just because we want to take advantage of opportunities and pick up small profits, like the 1.67 profit we see right now, $1.68. That doesn't come by just blindly placing trades. Lazy trading doesn't mean sloppy trading or random guesses or things that don't bring you real money. Lazy trading just means you're not worried about the market, but you still trade with the intent of making money, even if it is only $1 or $3 or whatever. It doesn't matter as long as your goal is to profit and you try to keep your balance as much as possible. So as we look at the chart, the yellow lines are the range that we have been trading in for this entire series. But the extra lines I have added, the white lines, are the highest high and the lowest low of the entire market throughout its 20-year history. This is important because this tells us exactly what kind of market we are looking at. We could see the entire depth of the market. We could see the whole range of where price has moved within the last 20 years. And by using that information, by studying the market and its history, for example, if we zoom out, we can see clearly where the highest high took place, and we can see clearly where the lowest low took place. And we have, of course, the dates on the bottom that give us a clue in terms of when those periods took place. We could also see how the market had severe shifts, and we can correlate that with historical dates and data to look at the economic situation that caused that particular period. So knowledge is everything in trading. And by looking at the monthly chart between the yellow lines, we see that the range that the yellow lines encompass clearly shows a large-scale trend for this market, the range of this market. And that is important. We see where we are trading. We see how likely the market is to maintain this structure. That gives us knowledge. That gives us information. Now, as we zoom in, we see two more lines on the chart. A pinkish light purple line, and that is the average of the market at 1.4615. Then we see a dark purple line, and that is the median of the market at 1.4823. While these lines don't look like much, they are critical in the information they tell us. From the standpoint of the market, let's zoom back out and look at these two lines. The pinkish line, the average. This is the average price of the entire market. The median. This is the high and low combined to give exactly where in the middle of the market that takes place. From the standpoint of the market, any cyclical market should revolve around the median. That is one of the most important factors to take into account for strategies that are mean reversion. By doing so, we have a clear distinction of exactly what we are looking at. With the average of the market being below the median, this tells us a very critical and important fact about the market. When the average is below the median, that means that the market tends to run short, or it tends to run on a lower radius, so that prices will tend to run low compared to the median, which we see based upon the chart. We see that for the most part, the average pricing is in fact below the median. And we can see that in the candle patterns. If the average pricing was above the median, then the market would be predominantly a long market, meaning you would want to trade in a long direction. This really goes back to why I chose to short the market to begin with, because the market automatically has a tendency to go low in terms of the price-value relationship to the median. So if I short the market, then I am more likely going to be in a better position statistically to profit. Now, of course, if the pricing is on the low end or the bottom, then I will likely want to long the market or pick up positions that would become anchor points in the future. But really, for this kind of a market, a long position would be better. Basically, what the median tells you, and this could also apply to the average depending upon your strategy, anything above the median should be a short. And anything below the median should be a long. That's horrible, but so that is the important part of your median. That separates the market into two distinct, clear possibilities. And if you want to use an algorithmic approach, then you would use two different sub-accounts. One trading short positions only, one trading long positions only, and you would maximize the effect of the market equally. Such an approach guarantees you the consistency of the market in a reliable way that you can clearly see. But for the purposes of algorithmic trading, for the purposes of lazy trading, we want to look at a closer view. So right now we're on the monthly chart. Let's go to the daily chart. And we can see the purple line being the median, the pinkish reddish line being the average. We could also see that our entry order was triggered. That's this order right here. We set it, it got triggered, but we can also see that the market really hasn't accepted that price. So even though the trigger took place, the market value dropped. So we are likely to see that value drop even more, or we can just cash out $1.97. $10 position. This is a 1.9%, 2% profit right now at the rate it's moving. We can set a stop loss. We can set a take profit. There are a lot of things we can do to really lock in these profits if we want. We could even set a trailing stop loss at this point and capture that price value. So let's take a look and let's actually set a trailing stop loss on this. That way, no matter what happens, it will trigger out if it continues to progress in the direction we want. So we're going to have a trailing stop, and I'm going to put the trailing stop a little below the pricing. So let's put the trailing stop right there. So what's going to happen is as the price moves, as the price continues to move, we're locked into a profit no matter what happens. That's the beauty of this trailing stop. We have a profit of $1.50, absolute guaranteed. If the price continues to progress in the direction we want, it's just going to capture it with this trailing stop. That's the whole beautiful part of when you want to use it. So we have a profit. Now we're going to keep that profit. So we've got a 1.5% guaranteed profit right now, no matter what. So we could just let this market ride and let the trailing stop take over. We could do better, we could do worse, we don't know, but it doesn't matter. That is really one of the benefits of lazy trading. And by having the information of knowing where the market is in relation to the market average, by knowing that we are above the average and we are above the median, by having these boundaries, and by being able to calculate that distance, we can have a reasonable expectation that the market is actually going to go cyclical and go back down to the median. A cyclical market always cycles around the median. Always. But because we know absolutely from mathematics that the average is below the median, we have even more of a statistical probability that the market is going to go in our favor. That is absolutely critical. When you take the time to analyze the market the way we did, you begin to see the patterns. You begin to look at the market in a different point of view. You begin to understand that the market has a certain flavor, a certain pulse. We could actually simply let this position sit until it returns to the median and make one hell of a killing. How long will that take? We don't know. But we can see by the dates on the bottom that right here is around February. So you're looking at February, March, April, May. You're looking at about 4 months. So quite possibly in another 4 months, it would be back down here again. The reality of it is I don't want to wait that long for one position. I don't have a lot of money invested in a single position. I have $10. That's it. It's not beneficial for a $10 position to wait 8 months. This is where you need to put into a correlative relationship of the value of your position versus how long you wait. Typically speaking, for a $10 position, a couple of days is more than enough before I consider either adding to the position, meaning making another purchase, like what I have done on the screen with these two, or I just look at the market and decide it's not in my favor and take a loss. By understanding your risks, by understanding the market dynamics, by seeing where things are going. For example, I believe the market could go back down to this level. We already know it's not willing to go above this level. We see it on the chart. The buyers and sellers have agreed right now that the upper boundary is where the price is going to stay. The lower boundary is questionable. We see really it hasn't gone below a certain point of view. That is just one of the many trade-offs that we have when we use this kind of an approach. It's basically wait and see. There's no excitement here. There's nothing of a grand hurrah, no theatrics or fireworks. It's just letting the market do what the market does. So as we continue, we can clearly see exactly what the market is doing by our analysis. We know where the market is going, and we know what to expect out of it by analyzing the median and the average and putting them on the chart. It's more information in terms of how we trade, in terms of why we trade, and in terms of the direction we trade. So I encourage you, take a look at the market, spend some time studying it, do a little mathematics. It's not that difficult to do addition, division, so forth. And that's really all this is. Simple mathematics. Take the time. And even when we look at the chart right here, we see another pattern emerging at this point. So it's very possible that our upper range could return to the area on the screen that I've marked. It's a very simple combination that has multiple retesting. Does it mean it will? No. Nothing is guaranteed in the market. But by putting statistics on our side, we give ourselves a better opportunity to profit. We give ourselves a better way to look at the market and make informed decisions. So as we continue with the lazy trading approach, we can clearly see just because we are lazy in our approaches, meaning we let the positions grow and shrink as they will, we are very educated in how we look at the market. We are constantly looking at exactly what the market is doing, whether it's by watching the news cycle and picking up on key elements, or just looking at the chart and seeing where price has been and how likely price is going to remain at a particular area. For example, with the median and the average right now, we can clearly see that current price has a high probability of going downward. That gives us an edge. That gives us knowledge about the market that we can use to profit. That knowledge can be used to help us continue in a real world situation to make money. That is the entirety of what we want to do. And that is why lazy trading is such a powerful tool and resource. Because it takes out the stress. It takes out the frustration. You don't need to be perfect. You just need to understand the market. And that is simply by watching it, drawing a few lines on a chart, and making a few educated guesses based upon probability and statistics. If you like this video, please give it a thumbs up so I can grow the channel. If you have any comments, thoughts, or suggestions, please leave them in the comments below. Share your thoughts. Tell me what you think of this approach. If you're using it, how is it working for you? Let me know. Thank you for watching.